Today's promise. By the end of this video, we'll know exactly what timeframes are, why they're so important, and how to use multiple timeframes together to make smarter, more confident trading decisions. If this is the very first time that you've landed on this side of the internet, welcome! I'm Caro Trading and I'm in the path of becoming a volume price analysis trader, documenting my journey as I learn. My mission is to break down VPA concepts in a way that is easy, actionable, and usable so that you can implement it in your own trading strategy and build your own success. And as always, don't believe anything I say, verify it. I kindly invite you to not take this information as facts. Instead, take the tools that I'm sharing with you and apply them through your own experience and see through your own results whether they work or not, because that's the only way to find the truth. In the previous chapter, we learned how price candlesticks are formed. We learned that it's due to the imbalances between supply and demand that the price either goes up or down, creating the final candlestick shape that you see on the charts. We also analyzed our first individual candlesticks, where we dissected the stories that they told us. In other words, we looked at the continuous tug of war that is happening between the bulls and the bears. The bulls being the ones that are bringing the price up, and the bears being the ones that are driving the price down. You can also see it as the constant war or fight that is happening between the buyers versus the sellers. Now, our goal is not only to be able to read individual candlesticks properly, but also to read groups of candlesticks. And in order to reach that goal, I'm going to take you through a journey, taking us from where we are right now to where we want to get. This is where we are right now. This would be you. And where we are right now is that we're kind of able to read a few candlesticks individually. But where we want to get is to be able to read groups of candlesticks together, because in essence, that's what chart reading is, and that's what trading is all about. But it turns out that in order to get to the other side, we first must add two pieces to the puzzle. And those two pieces are actually two concepts that are also relating to candlesticks themselves. And this is because every single candlestick is bound to two concepts. The first concept is the concept of price, where every single candlestick shows you the price movement that happened within that candlestick. For example, let's say that you have this white spread up green candlestick where the opening price is $1, the closing price is $3, and therefore we can conclude the following. The price went up by $2. Now, let me ask you something. Is a price increase of $2 a lot? Is that average? Or is that maybe very little? Because it's the equivalent of me saying to you, I'm going 30 kilometers. Doesn't say a lot, does it? You're probably also wondering, okay, is 30 kilometers fast? Is it average speed? Or is that slow as hell? And the answer is, it actually depends. Because when we say that I'm moving 30 kilometers, are we talking 30 kilometers per second? If so, then dude, you're a rocket. But if you're telling me, nah, I'm actually going 30 kilometers per minute, I'm like, alright, okay, you're still flying. But if you're telling me that you're going 30 kilometers per hour, okay, that's a little bit slower. It's still superhuman speed though. If you were to tell me that it's actually 30 kilometers per day, I'd be telling you, oh, you're just strolling. If you were to tell me that it's actually 30 kilometers per month, then I'm gonna tell you, dude, that's just a sedentary life. You're basically not moving. And this is what I mean with it depends, which leads us to the following conclusion. Establishing the distance alone, moving 30 kilometers, doesn't tell us much if we don't relate it to another concept. That concept being, you guessed it, the concept of time. And in trading is exactly the same thing. Establishing the price distance alone, it doesn't tell us much unless we connect it to another concept. That concept being time. And this is what I mean when I said that every individual candlestick is bound to two concepts. On the one hand, you have price, and on the other hand, you have time. In trading, we therefore must connect the price movement to a unit of time to get an idea of how strong or weak that dollar move actually is. So price alone means nothing, but price plus time equals context. And that we can work with. And this is why before we move on to reading groups of candlesticks, this chapter is going to teach you what you need to know about timeframes. So this part of the candlesticks over here. And in the previous chapter, I did say that in this chapter, we were going to focus on reading groups of candlesticks. And I must admit, I got a little bit ahead of myself. But as good traders, we not only adapt our trading strategy as the trades happen, but we also adapt our teaching as the teaching is happening. And that's exactly what I'm doing right now. My only intention being to give you as much value as possible and setting you up for success by building the proper building blocks in the correct order. Going back to our journey, this is what we've done so far. We already understand the concept of price. Now in this journey, we will be crossing this second bridge where we're going to be able to understand and really genuinely comprehend the concept of time relating to candlesticks. And understanding time frames is actually also the next intuitive step, because a lovely follower also asked in the previous video, I have a question. What determines the time frame of a candlestick? For example, how much time does a single candlestick represent? And does it depend on the chart settings? Let's answer this question then. In our food market example from the previous chapter, we looked at how the price of one apple changed during one business day. The business day being from 9 a.m. until 4 p.m. And the picture that you see down below is once again the price movement during the day that led to the making of the price candlestick that you see on the right. Note that when we say one day, we don't literally mean 24 hours. I know that a day technically has 24 hours, but in trading, when we say one day, we actually mean the hours that the business was open for that day. Relating it back to our food market example, one day would equal 7 hours from 9 in the morning until 4 in the afternoon. So this candle right here represents the price movement during one day, actually the one business day. In other words, it took this specific green candle right here 1 day to form, or this candle was printing for 1 day. And that is a new word. Printing. Some of you might be wondering, Caro, what do you mean when you say printing? It turns out that candlesticks are actually like clay. Clay is the material that you use during pottery class to make the vases. Just like clay, there is a period in which it's still wet. You know, the clay is still soft and therefore you can still shape it. You can change the form it has. Once some time actually passes, the clay hardens and it stays like that forever, like it becomes rock solid. In trading is exactly the same thing, where candlesticks also have a period in which their bodies and their wicks are changing shapes. And once some time passes, the candlestick stops changing shape and the body and the wick become final. So they remain like that forever. And once that happens, a new candlestick starts printing. Let me show you what I mean. What you're seeing in front of you right now is a random chart. And in this case, I picked micro gold futures. I've actually set the chart to the 1 minute time frame so that every single minute, a brand new candle is gonna pop up on the right side of our chart. And this is only to make the concept as visually clear as possible. I also added the countdown to close timer, which you see on the right. And this is telling us how many seconds, minutes, or days are left before the current candle actually finishes forming. And as you can see, the candle on the far right, so the one that is still forming, it's constantly changing shape. Sometimes the body gets bigger, sometimes the body gets smaller, and sometimes even the wicks gets longer or shorter. Even the color might flip from red to green or back to red again. And all of this movement is happening because of supply and demand, where it's buyers and sellers pushing the price up and down in real time. And that's why the candle looks like it's moving, because it is. It's not done printing yet. Then the moment the countdown hits 0, that candle becomes final, so it locks in. There are no more changes to the candle on the far right. And right after that, a new candle gets added to the row of candles and starts to form. Pay attention to what happens on the right side of your chart when the countdown finally hits 0. 3 more seconds, 2, 1, boom, a new candle starts forming. And the candles on the left are set in stone. In other words, they're printed like that forever. They're never gonna change shape again. And this is what it looks like in real life when a candlestick is printing, or in simpler terms, when it's still forming live on the chart. And by the way, this exact same logic applies to every single time frame, whether you're on the 2 minute, the 5 minute, 1 hour, 1 day, 1 week, or even the 1 month chart. Actually, let's take a look at the monthly chart. The only difference between the 1 minute time frame, which is a time frame we were just looking at, and the slower time frames like this monthly time frame over here, is that you will not actually see the candle change as clearly as we did on the 1 minute time frame, because the movements are spread out over many days or even weeks, so the changes happen much slower. But the idea is still the same. Until the time runs out, the last candle is still forming. And this is what we mean when we say that the candle is printing. So a candlestick that is printing is a candlestick that is still forming in real time, where the imbalances in supply and demand are making the price go up or down, and so the candle is still changing shape. The form is not final yet. So the body and the wicks are not final yet. They're still moving. But once the candle stops printing, that's the final version of that candle. That's it. It doesn't change anymore. And the next candle starts printing on the right side of your chart. This is what we mean when a candle is printing. Okay, cool. So that's the definition of printing. But then what is a time frame? So let's take a look at more real-life chart examples to make the concept of time frames actually stick. This is the first example. What you see in the screen is a snippet of a chart where every single rectangle that you see is a price candlestick. And we're on a monthly time frame, which means that every single individual candlestick that you see on screen represents 1 month's worth of price movement. In this specific case, we're looking at this green candlestick over here, which shows us the price movement that happened from the 2nd of December until Wednesday, January 1st, roughly a month. And this is what this narrow-bodied, long-wicked candlestick is telling us. At the beginning of the month of December, because we're on the monthly time frame, the price per share was roughly $19.90 per share. This is when the candle started printing at the beginning of December. Now, at some point during the month of December, the price per share went all the way down to roughly $19.20 per share. Also, at some point during the same month of December, the price went all the way up to $20.55 per share. And the price by the end of the month of December closed at $20.05 per share, where the close is slightly higher than the opening price, therefore closing as a green bullish candlestick. And this is when this monthly candlestick stopped printing and the next monthly candlestick started forming. At the end of the month is when the candlestick stopped changing shape. The clay hardened. So this specific candle right here took 1 month to print because we're on the monthly time frame. Let's take a look at the second example. In this case, we're in the weekly time frame, where every single candlestick then represents 1 week's worth of price action. So every single week, you see 1 new candle on your chart. And in this specific case, we're focusing on this candlestick over here, showing us the price movement that happened from Monday, April 27th until Sunday, May 3rd. And this is what the candlestick is telling us. On Monday, April 27th, the price per share was $33.10 per share. This is when this weekly candlestick started printing at the beginning of the week, which is on a Monday. Sometime during that same week, because we're in the weekly time frame, the price per share reached a high of $33.65 per share. And at some time during that same week, the price actually reached a low of $31.15 per share. And by the end of the week, the price per share closed at $32.25 per share. This is when this weekly candlestick stopped printing and the next weekly candlestick started forming, where the closing price is lower than the opening price, therefore closing as a red bearish candlestick. And in this specific case, one single candlestick is showing us the end result week after week after week. Not after every month, but after every single week, because we're in the weekly time frame. Now we're on the daily time frame, where, you guessed it, every candle represents 1 day's worth of price action, which is actually 1 business day. And we're gonna take a look at what happened on Friday, 2nd of October, 2015. For this specific candle over here, on Friday morning, when the stock market opened, when the businesses opened, the price per share was $27 per share. And this is when this daily candle started forming at the beginning of Friday morning. Now, at some point during that Friday, the price went all the way up to $27.75 per share. And at some point during that same Friday, the price actually went all the way down to $26.88 per share, marking the lowest price point during the day. And by the end of that same Friday, the price closed at $27.60 per share, where the closing price is higher than the opening price, therefore closing as a long-bodied green bullish candlestick. And this is when this daily candlestick stopped printing at the end of Friday. And that's when the next daily candle started printing. So in this specific case, you have to wait 1 full day for a new candlestick to start showing up on your chart. And then of course, we're gonna go all the way to the 5-minute time frame, where every single candle represents 5 minutes worth of price action. And we're gonna look at the price action that happened from 5:30 in the afternoon until 5:35 in the afternoon. And this is what the candlestick is telling us. At 5:30, the price per share was $203.30 per share. This is when this 5-minute candle started printing at 5:30 in the afternoon. Now, within those 5 minutes, the price per share did not go above $203.30 per share. And how do we know this? Because there's no upper wick. So the opening price equals the highest price point during those 5 minutes. Now, what did happen is that somewhere within those 5 minutes, the price per share went all the way down to $202.30 per share. And at the end of those 5 minutes, the price per share was actually $202.80 per share, where the closing price is lower than the opening price, and therefore we have a wide spread down red bearish candlestick. And it is at this moment when this 5-minute candlestick stopped printing. So at 5:35, this candle got cemented. That's it. It's not going to change shapes anymore. And then the next 5-minute candlestick started forming. And here, every single candlestick represents 5 minutes worth of price action because we're on the 5-minute time frame. So every 5 minutes, you're going to see a new candlestick appearing on your chart. Now, what can we take away from these examples? The time frame defines how fast we get a candlestick on our chart. When we're on the 5-minute time frame, a new candlestick starts printing every 5 minutes. But when we're on the daily time frame, a new candlestick starts printing every day, which means that when we're on the weekly time frame, we have to wait 1 full week to see a new candlestick appearing on our charts, which also means that when we're on the monthly time frame, we have to wait even longer. In other words, we have to wait 1 full calendar month. But that's not the only important thing about timeframes. Timeframes also give us a reference to understand the speed at which price moves within every single candlestick, allowing us to go from saying things like the price went up with $5 to actually being able to state things like the price went up with $5 in 5 minutes. Now that we attach the price movement to a unit of time, do we have a better idea of how strong or weak that dollar move actually is? Because let me ask you something. Would you rather buy a stock that moves $5 in 1 day versus a stock that is moving $5 in 2 years? Probably you're gonna choose the stock that moves $5 within a day. That's probably a little bit more exciting when it comes to profit making. See the difference? How do we select this time frame ourselves on our charts? We can actually select time frame ourselves through a drop-down menu at the top left of our chart settings on TradingView, where we can start our most commonly used time frames for easy and quick access in the future. There are multiple time frames we can select from the monthly all the way to the 5-minute and even the 1-second time frame. So to go full circle with your question, the time frame is determined by us through the settings that we put on our charts, where each candlestick represents the price movement that happened within that time. But there's more to this to timeframes, and the reason that I put a diamond emoji over here is because the thing that I'm going to teach you next is actually a gem, and I wish someone would have taught me the next concept the way that I'm about to teach you. Because it turns out that there are different ways in which one single candlestick can be formed. Because for the candlestick that you see on screen right now, it is very possible that the price opened, then the buyer stepped in, pushing the price all the way up. Then the seller stepped in, pushing the price all the way down. And then the buyer stepped in again, closing the price higher than it opened, resulting in this green bullish candlestick. It turns out that there's also another possible version to this candlestick, where the price opened, but first the seller stepped in, pushing the price all the way down. Then the buyer stepped in, pushing the price all the way up. And then the seller stepped in again, but the seller still didn't manage to bring the price below the opening price. So the price still closed above the opening price, resulting in the exact same green bullish candlestick. My question to you is, which of these two stories are correct? Because they cannot be correct at the same time. One of them has to be the truth and one of them has to be false. Which one is which? We then need to dissect this candlestick, in other words, open it up, the same way that we dissect a frog during science class. But the question is, how do we do this? And the answer is very simple, by using multiple time frames. I'm now going to teach you how to dissect candlesticks in a very easy way, so you don't have to struggle how I did. So it turns out that most people teach time frames like theory, but what I want to do is I want to turn this into a concrete example, which is how we can actually learn best. So the first question is, what are we looking at right now? What you're looking at are two charts side by side, split by a vertical line in the middle, which is this line right here. Both charts are showing the exact same same instrument, the instrument being platinum futures. So we're looking at the same market, the same asset, it's just two different views of the same asset. So what's the difference between the charts? The difference lies in the time frame. The left chart is the 4-hour time frame, whereas the right chart is the 1-hour time frame. And what does each candlestick then mean? One candle on the left, so on the 4-hour time frame, equals 4 hours of price action, whereas one candle on the chart on your right equals 1 hour of price action. So how is it that these two time frames actually connect? In order to explain that, we're going to be looking at the price movement that happened from 12 p.m. until 4 p.m. So it's a 4-hour price movement, which would mean we're going to be looking at one candle on the left, and the same 4-hour price movement is then 4 candles on the right, because we're zoomed in with a 1-hour chart. So again, one candle on the 4-hour chart equals 4 candles on the 1 hour. And the candle that we're going to be breaking down, in other words, the candle that we're going to be dissecting, is this 4-hour candlestick right here. This is the candlestick that we're going to open up with the help of the 1-hour time frame. Now, you might be wondering, what are these horizontal and vertical lines that are moving on your screen? This tool is called the crosshair tool, and it lets you move across both charts at the same time. So if you hover on one chart, the other also stays in sync. Pay attention that any movement that I do on the left gets copied on the right hand side. So if I go left, the vertical line goes left, and now I'm going to go down and both horizontal dotted lines are going to go down. Boom. And the last concept that we need to understand is the black label that we see at the bottom of our charts. This black label is communicating to us the exact time in which the candlestick started opening. So if we look at the 4-hour time frame, the black label is saying Wednesday, 13th of August, 2025 at 8 in the morning, which means that this specific green candlestick started opening at 8 in the morning. And since this candlestick represents 4 hours worth of price action, the next candlestick, which is the one that we're going to dissect, started opening only 4 hours later. So in the black label, we should see 12 p.m. Let's verify. Indeed, 4 hours later, the candlestick that we're going to dissect started opening up. That's why you see at the bottom of the chart, at the black label, 12 in the afternoon. Now, if we were to translate this on the 1-hour time frame, same logic applies. Let's take this candlestick, for example, where it says Wednesday, 13th of August, 2025 at 8 in the morning. It is exactly at this moment that this green bullish candlestick started printing. Now, since we're on that 1-hour time frame, this candlestick only represents 1 hour of price action. So after an hour, it stopped changing shape and the next candlestick started printing. And what is 8 in the morning plus 1 hour? It would be 9 in the morning, which means that the next candlestick should have started printing at 9 in the morning. Let's verify by hovering the mouse over to the right. Indeed, the black label changed from 8 in the morning to 9 in the morning. Now that we understand that one candle on the 4-hour chart equals 4 candles on the 1-hour chart, we're going to focus on the 1-hour time frame, and we're going to slide across the candles from 12 p.m. starting the opening until 4 p.m., which is when the last candle closed. And as we do that, I want you to keep an eye on the crosshair on the 4-hour chart, because you're going to see it move up and down inside that one candlestick that we're going to dissect, because we're still in the same 4-hour window. So we're basically just zooming in to see the smaller moves that make up that one big candle. And since both charts show the same price action, just in different zoom levels, certain things should actually line up exactly. Let's take a look. The opening price of the 4-hour candle should match the opening price of the first 1-hour candle. Let's take a look at that. The opening price of the 4-hour time frame is somewhere at 1,359.51. And indeed, the opening price of the 4-hour candle equals the opening price of our first 1-hour candle. The high of the 4-hour candle that we're dissecting should also match the highest point reached during those 4 1-hour candles. And what is the highest point that we reached during those 4 1-hour candles? It was somewhere here. And indeed, the high of the 4-hour candle matches the high of the 4 1-hour candles on the right, which is roughly at 1,368.11. And the other thing that should also match is that the low of the 4-hour candle should match the lowest point that we reach during those 4 1-hour candles. Let's take a look. I'm searching for the lowest point, and pay attention how as I'm going down, I'm switching candles on the 1-hour time frame, but on the 4-hour time frame, I'm still going down within the same candle. We still have not reached the bottom of the candlestick, And now, this is the lowest point of the 4-hour candle, which indeed equals the lowest point that was reached in the last candle of the 1-hour time frame, which is roughly at 1,339.97. And the last thing that should also match is the closing price, where the closing price of the 4-hour candle should match the closing price of the last 1-hour candle. Let's verify. So the closing price of the 4-hour candle, I'm gonna go up. The closing price on the 4-hour should be somewhere here. And indeed, it equals the closing price of the last 1-hour candle. This is how everything lines up. This is how we can dissect every single individual candlestick, where the 1-hour time frame is helping us dissect and open up exactly what happened inside of the 4-hour candlestick. This is how we dissect every single candlestick on our charts. And it is the only way to know who came first, the buyers or the sellers, which then ended up forming the final candlestick that we see. And the beautiful thing about this is that we can apply this dissecting technique on any instrument with any time frames. So this dissecting technique is not limited to, for example, only crypto. You can use it in stocks and you can use it in futures, in any instrument it is that you're trading on. Okay, cool. Now we know how to dissect candlesticks, which is an interesting skill to have. But some of you might be wondering, Caro, why should I bother knowing if buyers or sellers stepped in first? Because some of you might be thinking, for this green spread up candlestick, if we have a spread up green candlestick, isn't it obvious that buyers are in control? Because look at how wide the body is and it's clearly green. So obviously the buyers must be dominant, right? Not really, no. And the reason for that is that this spread up green candle actually has two versions. It has a weak version, which means that it also has a strong version. Let's look at the weak version and then compare it to the strong version and come to some very interesting conclusions. Let's say that in the weak version, the candlestick opened, and right after, the buyers pushed the price steadily up. And right after that happened, the price went all the way back down. In other words, sellers fought back. But then the price went back all the way up, and it happened very last minute. So the conclusion is we have a spread up candle, which is white, but the buyers had to struggle in between because the sellers were giving a fight. Now let's take a look at the strong version of this candle, where as well, the candlestick opened, and as well, the buyers immediately pushed the price steadily up. But in this case, the price never went back down. So the sellers never fought back. So yes, the conclusion is the same. You have a white spread up candle, but in this case, there is an easy win for the buyers because the buyers never had to struggle. So on the one hand, on the weak version, the buyers had to struggle. But in the strong version, the buyers did not struggle. And we're talking about the same candlestick over here. Now, let me ask you a question. If you had to buy, which candle would make you feel more confident to do so? The one where buyers won easy, or the one where the buyers struggled? And why? Pause the video, really think about this. Most of us probably answered the one where buyers won easily. Because when buyers are winning easily, it means that the buyers are clearly in control, not the sellers. The buyers, which means that the buyers have the upper hand. And if they have the upper hand, then most likely the buyers are going to continue having the upper hand. So therefore, the price is likely to continue going up, which is exactly what we want when we buy. But when the buyers are struggling, the buyers are then running out of steam, which means that the buyers might then soon lose control. To whom? To the sellers, which means that the chances are higher that sellers are going to take over, which means that the chances are even higher that the price is going to be brought back down. And that is exactly what we do not want when we're buying. And this is why it's so important to learn how to dissect candlesticks. Dissecting candlesticks through multiple time frames allows us to understand to what extent the bulls or the bears are controlling the market. And that is what allows us to make confident decisions about when to buy and when to sell. So congratulations, because we learned a key trading concept, which is that of time frames. And we are now finally strongly equipped to interpret groups of candlesticks. Zooming out again, taking a look at our journey, we are here right now. We crossed the first bridge, the second bridge, we understand price and time, and now finally we can cross the third bridge to be able to interpret groups of candlesticks, which is exactly where we want to get. And this brings us to the next session. Since we are now finally well equipped to successfully analyze key candlesticks and groups of candlesticks that often appear on the charts, we're gonna zoom in on the following. We're gonna take a look on the candlestick that is called the hammer candlestick, but you also have the morning star, 2-bar reversals. This is when you actually take 2 candlesticks together. And we're even gonna look at price waterfalls and more. And it's very okay if these names mean nothing to you right now, because the most important thing that I wanna highlight is this is not about memorization. It's about understanding what these candlestick shapes tell us. I don't want you to memorize the names of the candlesticks. The names is secondary. The key thing is to actually comprehend what is the story that the candlestick is telling me. Forget the name, forget memorizing things. It's about understanding. So thank you so much for lending me your most valuable assets, which are your time, energy, and attention. And I promise you that I'm going to continue doing my best to give you the highest possible return on them. And as always, enjoy the process, unless you've got other plans.